So one of our YouTube followers came up with a great trade idea for an options trade in Google with a huge range over which a really nice profit can be made. I'm the head trader of SMB Capital's options trading desk here in Midtown Manhattan, and the options traders on our desk are constantly seeking outstanding setups like the one that I'll be breaking down for you in this video. This trade has a statistical 84% probability of profit for a very nice return over an extremely wide range of Google prices. I'll show you how this trader set things up to really stack the odds in his favor, and the trade is pretty easy to understand, so stick around. I think you're going to find this eye-opening. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so we did a video about a month ago where we went through a campaign of options trades known as iron condors, where we tracked Amazon stock throughout this year, showing how we could have set up every 60 days throughout the year a 2-month-long trade that could have hypothetically produced over a 50% return if methodically traded throughout the year. At the end of the video, I asked traders to suggest similar trades for stocks that the viewers followed, and we track a few of them to see how they'd actually turn out, and we got some really interesting ideas in. So Scott Summer had suggested that we take a look at the following trade, which is known as an iron condor in Google for the December monthly expiration, which takes place on December 20th. Now, let's break down what Scott is suggesting here, and we'll take a look at the risks and rewards inherent in the trade so you can get a feel for what he's actually suggesting. So on the day that Scott is suggesting we enter the trade, which was October 25th, 57 days before the expiration of these options, Google was trading at $12.66 at that time. As you can see, Google was trading up around its all-time intraday high, which was $12.89 back in May. So here's exactly what Scott is suggesting. He's looking for us to sell 2 of the 1,400 Google calls and buy, as protection, 2 of the 1,520 Google calls. Then he was suggesting that we slide all the way down to the Google 1,100 puts and sell 2 of those, and then as protection buy 2 of the 980 puts. That combination of a short call closer to the money protected by a long call farther from the money, combined with a short put closer to the money and a long put farther from the money, that entire combination is what is known as an iron condor to options income traders. Now, from a cash flow standpoint, you can see that the 1,520 calls cost $76 because, as you know, each call represents 100 shares of stock. So the calculation is 2 times 100 times the cost of the call, which comes to $76. With similar math, you can see that we received $962 for selling the 2 1,400 calls. We also received $1,028 for selling the 2 1,100 puts, and finally, we had to pay $220 to buy the 2 protective 980 puts. So as you can see, overall, the trade produces a little under $1,700 of income, which was close to the range of pricing that Scott had suggested for the trade. Now, let's take a look at the underlying logic of the trade. Now, as you probably know, a call option entitles you to the right to buy 100 shares at the strike price of a call option at any time before it expires. And a put option entitles you to sell 100 shares of the stock at the put's strike price at any time before the option expires. So in the case of the 2 options, we sold the 1,400 and the 1,100. Unless Google gets to 1,400 or below 1,100, those options will have no value on expiration day. So what that means is that as long as Google stays between 1,100 and 1,400 between trade entry and when the options expire, then all of the options in the iron condor will expire worthless. Why? Well, let's think about it. Exactly who is going to exercise a 1,400 call that we sold them if Google is trading at less than 1,400? No one is going to buy shares from you for more than they're trading at in the open market. So the 1,400 call you sold them has no value. yet you were paid cash for that call. The same is obviously true of the 1520 call, which you bought as protection. That goes out worthless also. Now, conversely, if Google is trading somewhere above 1100, then no one's going to exercise those puts and sell you their shares at Google at lower than they're selling in the open market. So those options are obviously also worthless. And for that same reason, the long 980 options are also worthless on expiration. So all 4 options expire worthless, and therefore you just get to keep the cash that you got in the beginning of the trade. A little less than $1,700, in other words. So essentially, what Scott was suggesting was that it's reasonable to think that somewhere around Google's all-time highs might act as resistance for Google, and so the 1400 call we sold is unlikely to do anything but expire worthless, because at that time 1400 was more than 100 points above the all-time highs. And similarly, he made the judgment that since Google has not been down to the 1100 level since early summer, that it has a reasonable bet that the 1100 puts we sold will also expire worthless. So that's the underlying logic of the trade and the technical analysis that Scott made in formulating his suggested trade. Now, before we run through exactly how a professional trader would have handled this iron condor options trade and how the trade turned out, I wanted to mention that we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 real-world option strategies that professional traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with the stock that you like, where you'll make your target profit, whether the stock goes up, goes nowhere, or even goes down a small percentage. Then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of the screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head over to optionsclass.com to register for this free intensive workshop. It is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. So let's now take a look at what happened on this trade and how a professional trader would have handled it. So we'll move over to November 7th, and you'll see that Google has blasted through its all-time high and is now trading at 1322. Now, I want you to focus on the short puts at 1100 and the long puts at 980. That combination, when we first sold them as the put side of the iron condor, sold for $4.04. Why do I say that? Because we received $5.14 for the 1100 put, and we paid out $1.10 for the 980 puts, so the net effect of that was to receive $4.04 at the outside of the trade. So the short put and the long put combined is called a put spread. And as you can see, the value of that spread has shrunk down to 56 cents on November 7th, because the short put at 1100 has shrunk down in value immensely, and the long put has also, but at a slower pace, because it wasn't worth that much in the first place. And it has done that because the stock has rallied, so the market is giving less and less value to all the puts. So what that means is that I can close that side of the trade for 86% less than I was paid for it. So a professional trader, like the guys on our desk here, they see that and they say to themselves, okay, look, I was paid $4.14 for that spread originally, and I have that $414 in cash for each of those spreads that I sold on the put side. Well, I can now close that side of the trade just by paying $56 for each of those spreads. So I can net out 86% of the original credit I received, and here's the important part, I have no more downside risk on the trade. Google could drop to any number, it could drop to 0, and I would have no risk at all on the downside of the trade. Because if I did not close that side of the trade, and by expiration day, Google for some reason had a huge sell-off to say 1075, thereby dropping below 100, I would be forced to buy Google at 1100 even though they're worth only 1075, taking a $25 loss on each share, and I sold 2 of those puts, so that would be a loss of $5,000 if that were to happen. So to eliminate that risk, after squeezing 86% of the value out of those put spreads, the professional trader would scalp the put side. In other words, close the put side of the trade and just pocket the profit. You see, we only have to pay $112 to close the put spread, but we originally received $808, leaving us with a profit of $696, and more importantly, from a trader's point of view, no risk to the downside. Now, if we move forward to December 3rd, you'll see that Google has now sold off a bit, moving farther from that 1400 short call for which we're still on the hook if Google rallies up to 1400, and we'd have to buy back those shares at 1400 when the stock is trading higher than that. So now let's take a look at the call side of the trade, and you can readily see that the market is assigning very little value to the possibility of Google getting to 1400 in the 19 days before those options expire. You see those 1400 calls? Well, when we first entered the trade, we were paid $4.81 for those. Well, now they're trading for 38 cents. And the 1520 calls that we paid 38 cents for at the beginning of the trade, those are worth 28 cents. So the implications of this is huge. It means that we can buy the call side back, that call spread, for 10 cents when we were originally paid $4.43 for them. In other words, we can buy them back for less than 3% of the value that we were paid for the call spread originally. And that, of course, would end the trade because we've now closed all 4 legs of the Iron Condor. So Google can now go to 0 or to infinity, and we have no risk. The trade's over. Instead, let's tally up what has actually taken place on this trade. So we've just closed the call side for a dime, and as you can see from the calculation, that leaves us with $866 of profit from the call side of the trade because our cost to close was only $20, but our original cash received was $886. So putting it all together, we made $796 from scalping the put side, and with Google selling off, we were able to scalp the call side for an additional $866 for a total profit of over $1,500 simply by making the bet that Google would not rally way past its all-time high or sell off down to a level that it has not seen since early summer. That sounds like a reasonable bet to me, and it turned out very well, which you'd probably expect from a trade with an 84% probability of profit in the first place. So this video really had 2 very important takeaways. The first one involved how easy it is to set up a trade that gives you a huge runway around the market price of a stock you follow through the use of an Iron Condor. But the far more important takeaway is that a professional trader knows when to shut down risk when the remaining profit potential of any aspect of any trade is minuscule compared to the remaining risk of the trade. With options income trading, these risk-reward relationships change over time, and it's critical to understand how those relationships change and then to take your profits. Pro traders are constantly thinking about risk and reward in trades, and if you want to get to the level of a professional trader, you need to start thinking that way also. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, and you'd like to learn the details of 3 real-world option strategies that professional traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now it's your turn. If you have a stock that you follow that you think might be a good candidate for an Iron Condor, go ahead and place the strike prices for that stock in the comments section below, making sure to provide me with the options chain expiration dates that you'd use. And if we find some interesting trades, we'll do another video like this one and learn some more Iron Condor management lessons that we can share and work through together. And if you found this video helpful, don't forget to press on the subscribe button below, because we're constantly shooting these videos with these kinds of valuable trade ideas in the future, and I don't think you want to miss them. Thanks.